you can't often say, we've waved a magic wand and we've saved you an absolute fortune. But it's more about sometimes in that situation de-risking rather than Jersey trusts and sort of Maltese two-tier structures and all of this kind of exciting stuff. And you can do that, but the sort of, because of revenue's got a much more aggressive approach to what they consider to be tax avoidance these days.
The following interview is with Paul Brown, who is the tax director at In Accountancy. Paul has worked for over 30 years as a tax expert in the UK, and he has previously held the position of Inspector of Taxes at the HMRC. We talked all things business and personal tax considerations, and what is currently happening with the legislative climate in the UK. I hope that you enjoy this one. The first question I had was, before this interview, I actually had a look, just a little bit of research myself, and you actually used to be an HMRC officer yourself, right? And then you switched to the private sector. So I'm just wondering how that came about, what made you switch?
I think it was probably quite a well-trodden path back in the day when I did make the switch, because essentially back in when I started in tax, the formal tax qualifications hadn't really taken off then. They were there, but they weren't terribly popular, and a lot of firms actually recruited inspectors from what was the Inland Revenue back then. Because the training at HMRC back in the day was actually considered to be the gold standard, I suppose. So it was quite, I was actually ended up working in the private sector, but with quite a lot of people who had previously worked at HMRC. I think, things have obviously changed now with the fact that the tax qualifications are probably, so much more robust these days. And I think that's absolutely the way to go for people now. But back in the day, if you were a fully trained tax inspector, as I was, then that was really considered to be, the best training that you were going to get. So it was quite an interesting transition, though. Very much an interesting transition when I made it.
And in terms of the changes that have happened since then to the legislation, to how businesses process their tax affairs again, would you say it's quite, it's getting more complicated, and it has gotten more complicated over the last 30 years? Or is it the case that, again, there's a lot of automation as well, it's actually more simple in those terms?
Oh, no, I think it's far more complicated. I mean, each year the legislation, if it was a physical book these days, gets thicker and thicker, and it's more and more complicated, and the government keeps introducing new measures that, they did go through a programme of, supposedly simplifying the legislation, but all that did was actually in the end make it much more complicated. Because I think the big shift that we've seen over the last few years, just generally in the approach, is what we used to have is what you'd effectively call a principles-based approach. So the law set the principles, and then it was up to, the advisors, the client, and the tax inspector to interpret it. Whereas now they try to be a lot more prescriptive in terms of trying to cover every single angle and every possibility. And all that means is that you need more and more provisions, and so it gets more and more complicated. And we're in a self-assessment system, and how realistically any sort of, client, whether they be an individual or a decent sized company, how they're supposed to actually be able to sort of get their heads around all of this legislation and be compliant is a real mystery, to be honest. So yeah, it's a pretty complex environment, and getting more complex all the time, I'd say.
In terms of that complexity, would you say, if, say, for example, today you're put in charge in terms of any tax reforms, anything to do with how the returns are filed as well, would you say there's a clear path to how it could get more simple going forward, and also obviously reduce expenses for businesses? Or it's just, it's one of those things where, because it's built up over the years, it's one of those webs that just can't be untangled, really?
I think you'd almost have to go back to ground zero, to be honest. It is so complex. There's so much now that you would have to unpick, I think. To think about some of the rules. A classic one in the UK, obviously, from a capital expenditure point of view, we've now got rules that say you can effectively deduct 100% of the capital expenditure that you incur on, up to certain limits from a business point of view. But that only extends as far as things like, plant and machinery. So effectively kit, really, that the reliefs for buildings are, much less generous, and yet we want people to be investing in infrastructure. So you've got an incentive to invest in the kit that goes into a factory, but you haven't got an incentive to actually build the factory yourself. And I think, just aligning that a lot more maybe with the accounts approach. I think in fairness that, these days the tax system is much more aligned with accounting. So the adjustments we have between tax and accounting are much less than they were. But because there's a certain paranoia, I think, that if you let sort of businesses go off their accounts profit rather than the taxable profit, that they'll manipulate that to pay less tax. And I think what the authorities don't necessarily understand is it's not always in the interests of the business to try and make their accounts look worse. They actually want to make them look better and make themselves look more profitable. So I think it's almost counterintuitive in that sense. But I think just aligning more and more so the reader of the accounts is also getting a decent sense about what the taxable profits are of the business as well wouldn't be a bad starting point. But there's so many layers of legislation that where you'd even start with that. I think you would effectively say, right, from 6th of April, whatever year it was, we're just switching off the old system completely, and this is the new system we're going to start with. So good luck to anybody who wants to try that, I have to say. So
when you say that some of the businesses, they actually do want to show the profits, they want to show that they're profitable, could you just give some examples of where that would be beneficial from the standpoint of the company directors?
Well, I think clearly if you're looking to move into your world for a moment, having the look of the accounts in terms of realizing value at the end of it. Obviously, you want the company to be more profitable. I think from that perspective, if you're looking at obtaining funding, I mean, this is kind of, I guess, all of the normal commercial stuff that you'd expect a business owner to be thinking. If I want to grow the business, I want to get funding, then I want to present the best possible picture to the potential funders so they know that I'm a good risk and that they want to lend money to me. Or, if I'm going to sell my business, I want to make sure that the numbers look solid. So as there's a trajectory of growth, which means I'm going to get a great value at the back end. I think that the perception within, certainly, and look back in my day, it went in the revenue. It was absolutely the perception that pretty much everything everybody did was to reduce the amount of tax that they have to pay. And I think it's kind of a lack of a grasp that commercially, actually, often it's the reverse. And obviously, clients don't want to be paying any more tax than they have to be. But if they're paying a decent amount of tax, the chances are that means that actually the business is doing well as well. And so it's not just a case of everybody's trying to sort of get away with paying the least tax that they possibly can. The tax often is a bit of an afterthought, really, from a client. I'd wish they'd talked to us about it earlier, typically, from a tax point of view. If people are doing transactions, we'd like to be involved earlier so we can maximise the tax benefits from it. But they're driven by that. They're driven by the commercial need to grow the business and deliver the results rather than because they want to try and, squeeze and reduce their tax bill by an extra 1%, for example. So I think there's a bit of an understanding gap, really. I think between the authorities and just real commercial life, I guess.
When the business owners come to you, and you just mentioned an interesting point, which is that sometimes you say, well, hopefully they would have started doing the work on that tax affairs earlier, right? And put things into place. What are some of the common, would you say, like mistakes that you see from business owners when it comes to it?
So I think, a classic might be, they've decided they want to buy a new building for the business, for example. So that there's a number of different things that either can go wrong or they can maximise the benefit from doing that. So first of all, where are you buying the building? Are you buying the building personally? Are you buying the building in the business? Are you buying the building in your pension fund? There's different pros and cons to each of those. So understanding who's actually going to be the purchaser is really important. And often, we get to the point where we're presented with a contract and say, right, can you just have a look at this for us? And it's too late to influence that because the wheels are already in motion. VAT on commercial property can be an absolute minefield. Are they going to have to pay VAT on the purchase? What does that do to their stamp duty liability? Again, by understanding that early doors, we can help, effectively almost the investment case. Even down to, if we can get in early enough, there might be the possibility that we can help the client to sort of maximise the capital allowances, the tax benefits that they can get from the purchase of the building by negotiating with the sellers on the tax side and seeing whether the sellers are prepared to kind of pass on some of those tax deductions to us as the purchaser. If all you get is effectively, I'm buying a building tomorrow and here's the contract and can you just have a quick look over it, your ability to influence all of that stuff is really kind of minimal, to be honest. So the earlier we're involved, the more we can influence the process and just make sure they get, we're not looking at doing anything other than just making sure that they're maximising, the benefits, but also de-risking it as well from that point of view.
From the business owner standpoint, and this is something that's come up before when I've spoken to other specialists in other fields, they always think, okay, well, what can we do up to a point where we don't need to pay someone, extra for the consultation, and then get to the point where once we're there, that's when we'll do it. So how do you usually approach that conversation?
I think, if we can get in early enough, it's about investing a bit of time with the client and kind of reassuring them that we're not on the clock, that, there isn't a clock ticking for it. And every time we have a conversation with them, they're not going to get charged for that. So, often you might spend 1-2 hours, maybe more than that, with the client over either, in one block or over a period of time, just talking about the options, scoping out what work we might actually be able to help, but also I think explaining the value to them as well and helping them to understand. And the value can either be tax savings or it can be reducing risk. So I think, there's two sides to the coin, but if you can take away tax risk from a transaction and help them sleep at night, but you've got to be prepared to invest that time up front. It's not a case of, well, let's have a chat and it's going to cost you, £300, £500 for the meeting. It's let's have a chat, understand what the needs are and see what solutions, and often, sometimes it may be that they've got everything covered or there's nothing particularly that we can add, in which case, great, everybody moves on. At least they know that they've talked about it at that stage, rather than, kind of the classic, I've just done this, what do I need to do from a tax point of view? And the answer is usually, well, you need to kind of go back 6 months in time and tell me about it before you do it. So, but clients need to feel comfortable that they're not going to get charged a fortune just for the privilege of having a conversation to understand whether there is something that we can do to help them.
In terms of your involvement with the client, let's say when it comes to, and this is what we talked about on this podcast, it's usually the sale of the business, it's usually the exit. So what would you say are some of the crucial points that come up? Obviously, you gave an example of where someone is buying a building, the building is being sold as part of a business. What else comes up for you usually?
I think there's a big piece around at what level the client's going to sell the business. So, often we're dealing with a group structure where you might have a holding company which has, cash and assets in, and they've got a trading company. And there's very different tax outcomes in that situation, for example, where you sell a holding company as opposed to when you sell the trading company out of the holding company. So, and it really depends on what their aspirations are and what they want to do with the consideration that they're getting. So, if this is I want to retire and go and, sit on the beach in Barbados or buy myself a McLaren or whatever, then obviously they want the cash in their hands, in which case you're looking at, we'll sell the holding company, and effectively the cash goes to them. They pay capital gains tax on that cash, but once they've paid that tax, it's their money to do with as they want. But often, particularly for younger or kind of serial entrepreneurs, they're not actually that concerned about having a big amount of cash in their bank account. So they might look at, well, effectively selling the trading subsidiary out of the holding company in that situation. And, if it's a trading company, then from a corporation tax point of view, you can sell that company and it's totally tax free at that level. So 100% of the proceeds goes into the holding company, which means that they've then got more cash to reinvest, to sort of start again, to build new businesses, to kind of go and buy, whether it's commercial property they want or whatever. And, we tend to find, actually, it's surprising. You kind of intuitively might think that most people just want the money in their personal bank account. But actually, if they're thinking, well, I've got a few years left in me here, I want to kind of go again, actually selling a trade co level rather than a whole co level actually gives them more cash to play with post tax. So it's kind of those conversations. Are there bits of the structure that the buyer isn't necessarily going to want? What can we do to actually get those out in advance of the sale or part of the sale? Let's help you tidy the group structure up to make sure that you've only got the stuff in there that is going to make somebody like your job easier in actually selling it, and there isn't any poison pills in there that the buyer's going to look at and say, well, we don't want that. Why on earth, like a client we've been working with for a while, why have you randomly got a residential property sitting in this manufacturing company? It makes no sense at all. And so can we get that out in advance and just almost, I guess, help them to present something to a buyer which they can just tie a nice bow round to say that this is what you're buying. There's no extra bits in there that need sorting out. There's other things like sort of remuneration planning in a lead up to a sale. If you can reduce the amount that you're taking out of salary and dividend paying income tax on, increase your free cash on a transaction, then you're only paying capital gains tax rates on that rather than paying income tax rates on it. you've got to be careful that the revenue don't think that you're taking the mickey a little bit. But within reason, there's ways that you can maximise the post-tax return by doing that as well. So there's a whole raft of things, and even down to classic. We were talking to a potential client the other day. His wife's a shareholder, but she's not a director. She's not an employee of the business. So from what used to be called entrepreneurs relief, she doesn't qualify. So she doesn't get the sort of the reduced tax rate, because you've got not only to be a shareholder, you've got to be a director or employee as well. Simple fix, make her a director. 2 years time, if they sell it, then she's going to qualify for entrepreneurs relief and effectively reduce her tax bill. Now the reduction isn't massive, but it's if you don't do that, even at that most basic housekeeping level, then you're paying more tax than you really need to on the transaction. So there's a whole world of things that we tend to talk to clients about in this context. So
the last thing that you mentioned, which was entrepreneurs relief or the business asset disposal relief, how have you seen the changes to that over the last 12 months impacts businesses from a practical standpoint, if at all?
I think it's an interesting one, because obviously a lot of people were running around trying to get transactions done before the 30th of October there, and in the end, the changes weren't anything like as bad as I think people were expecting. And you do get the sense that there might have been people who've got a little bit of seller's regret, having done a deal to try and get in before the 30th of October and maybe not got the best deal that they possibly could. I think people have kind of got used to the new world order to a certain extent, and also I think they're starting to realise that actually, BADR, business asset disposal relief, it's worth having, but it's also not life-changing amounts of money that you're kind of saving by having access to it. So I think the rate's gone up from 10 to 14% on the first million. It goes up to 18% next year. So effectively, the maximum that any one individual can save by doing a deal before 5th of April is 40 grand, 44% on £1 million. So I think there's a growing realization that actually it's all about getting the best deal that you possibly can, as opposed to trying to rush a deal to get done to save what in the scheme of things may not be a material amount of tax. So whether we'll still see a bit of craziness in the lead up to 5th of April with people trying to get deals done to save that extra 40. And look, frankly, if you can, as long as you can get the deal done and it's a good deal, then why wouldn't you try and save it by getting it done before the change in the rate? Mm-hmm. But people seem to be less inclined to make rushed decisions just off the back of the tax. And again, it's the old cliche about you don't let the tax tail wag the commercial dog. You make sure the deal's right and then get the tax right off the back of it, I think, really.
I think, we've seen it quite a lot as well, where whether it's a buyer or seller of a business, whenever they try and reduce that time and really rush things across the finishing line, that's when things go wrong. That's when you get underpaid, essentially, at the end of it.
Yeah. I think that was very much the sense that I had. Fortunately, we didn't have too many clients who were trying to do that. But you've heard about some quite odd, strange transactions and massive amounts of deferred consideration being kind of sort of held back or whatever, just to try and get deals done before the budget. And in the end, the difference that it made for a lot of people was actually relatively immaterial, really. So, it's easy to get caught up in a wave of speculation in the lead up to a budget, and then kind of realise that it actually wasn't nearly as bad as you were expecting it to be afterwards. So.
Speaking of budget changes, I mean, you've spoken before about the inheritance tax proposed changes and what's happening there. Could you perhaps talk a little bit more about that and what your view is on the proposed changes?
As matters stand at the moment, if you've got a trading business, that's your main asset, say, for the sake of argument, and you kind of die in the saddle, and you sort of have the shares in that trading business at the date that you pass away, then it effectively, from an inheritance tax point of view, there's generally no inheritance tax on the value of the business. But also there's a nice kicker, because effectively the beneficiaries of your will are treated for tax as if they'd bought the shares off you at their market value at that date. So effectively there's a double bubble in that sense from a tax point of view. Now, obviously, I think we've all heard about the things in the press about people going out and buying vast tracts of farmland to try and reduce their inheritance tax bills and things like that. So the government's response has essentially been to say, well, okay, we're going to put a cap on that 100%, what they call business property relief, on the value of the shares for IHT purposes. So what they're essentially saying now is if you've got, whether it's in most cases it's going to be a limited company, it might be a partnership share, it could be agricultural, it could be a farm, for example. But essentially, only the first £1 million of value that's in your estate at death is going to be totally free from inheritance tax. And then over and above that, they're effectively saying that for every pound that you have in value over that £1 million limit when you die, effectively there's going to be a 20% tax rate on that from an inheritance tax point of view, which I think is a pretty massive change. And bearing in mind that these reliefs were introduced originally because the whole point was that the government didn't want to cause disruption to business when the owners died. They didn't want people to have to potentially look at selling assets in order to be able to pay the inheritance tax bill. We've kind of gone completely into reverse as far as that's concerned. And your issue is that £1 million of value is obviously a substantial amount, but as soon as you go over that, that's tax that that your sort of personal representatives, the people who benefit from your estate, are going to have to find. And often the only source of that cash is potentially from the business, because that's been the main asset that's been passed down. So how do we then do that? Are we looking at potentially, do we have to sell to fund it? I mean, the one positive is that you're going to have 10 years to have to sort of spread the tax out in installments without interest. So it's not going to be, going to be in a situation where 6 months after death, you're going to have to find 20% of the value of the business from the inheritance tax point of view. But you still got to look at how you're going to fund that, and if people's only source of the funds is effectively money from the business, they're going to have to pay income tax to take that out to then pay the inheritance tax on the estate. And I think it just introduces a massive amount of uncertainty for those people who traditionally have kind of thought, well, the best thing I can do is really hold the shares till I die, and then everybody gets, there's a great tax outcome for everybody in that situation. So a whole world of planning has been totally turned on its head as far as that's concerned. I mean, what is interesting, I would say, is whilst obviously the farmers, because it impacts them as well, the farmers have been, very, very active. All the protests that we've seen, all of the sort of press coverage that they've attracted, we've not seen that same level of activity from sort of family businesses. There are pressure groups there that are making representations to the government, but whether it's just the message hasn't hit home to the same extent, whether there's a sense increasingly these days, because family succession is not quite a thing of the past, but it's not necessarily the default like it perhaps used to be 30, 40, 50 years ago. Maybe they're thinking, well, actually, I'm likely to convert the value of this business into cash hopefully before I die anyway. And in that situation, all of that IHT relief disappears anyway, but there doesn't seem to be the same, whether it's an awareness thing, as I say, or whether people have essentially said, well, it probably isn't going to be an issue because I don't intend to own the business by the time I die. We haven't seen the same level of kind of pressure, the same interest from clients, frankly, to be talking about this stuff. Than we would do if you were working, like I used to in a firm with a big rural client base, where farmers, they are traditionally asset rich, cash poor, but farmers typically, pretty much everything they do from a tax planning point of view is just about preserving wealth for the next generation. That's what they do, and so I think they see the impact of this much more clearly than perhaps business owners do, I guess. I think it'll start to hit home at some point, but time's running out to sort of really start to take really meaningful steps, in advance of April next year.
What's your personal view on inheritance tax? Is it double, triple taxation, which is not justified, or does it have its place and it should be in place, but perhaps it should work differently?
I think there is to a certain extent it has its place, right? Because but because there are at that kind of super rich end, there is a sense in which assets just gets handed down from one generation to the next, and it's in that situation, it's the capital value that's getting passed on rather than necessarily the income, obviously. But I think the level at which it kicks in is far too low, frankly, from my point of view. If you think that now, with perhaps a typical sort of married couple, or civil partners who, have got a house which might be worth £500,000-600,000. They might have a bit of cash, few ISAs, something like that. £1 million in terms of value, which is effectively the maximum that you can pass on, without inheritance tax. In this day and age, that's not a huge number. So, and particularly when we're now in April 27 looking at bringing in the value of people's pension funds into the IHT net as well, to be taxing people who are probably living comfortably but no more than that, and having they're being 40% paid on the value of the estate which they have generated by their own hard work, I think is crazy. So I think there needs to be a relook. There's things you could do. Do we look at lifetime gift taxes, for example, rather than a tax on death? Do we look at increasing the threshold so as it takes a lot of these people out? Because the IHT threshold, the basic IHT threshold, is 325,000, and I mean that's not moved for, I can't remember, 15, 20 years, something like that. So just by fiscal drag, effectively, and just by virtue of inflation, more and more people are getting dragged into the net. As house prices go up, that's going to continue to be the case. It's not taxing the people who are kind of hoarding wealth and then passing it on to the next generation. It's taxing people who are working damn hard to try and achieve a comfortable standard of living, and are falling into it because they've owned the house for 20 years and it's just by dint of inflation gone up in value to drag them in. So I think there's a merit to some sort of tax, but I think again it's something that really just needs to be relooked at, and kind of rather than trying to drag everybody into the net, think about who the real target's here and focus it on that, I think.
Mm-hmm. And speaking of taxing the ultra wealthy, the non-dom regime changes to that, how that ended. Again, there was a lot of speculation about it. There was, people are saying now there was an exodus. There's an exodus happening right now. From your side, what are you saying in practical terms? Has it made as big of an impact as everyone was saying it would? Do you see it as having like a negative impact also long term for the UK? And what do you think will happen next with it?
Yeah, I mean, it's an interesting one because we don't have too many people who are kind of in that non-dom category within our client base. So I can't really speak from practical experience, but I think, certainly anecdotally, you understand that people are leaving. But I'm always a wee bit skeptical about that. In terms of how people measure the numbers. It's amazing how people can come up with statistics off the same data set to prove, their case whichever way they want to go. I don't think there can be any doubt there will be people who will be leaving, because effectively, and I there's one thing is the income tax side of things, which, okay, if you're taxed on your worldwide income rather than your just UK income, that's painful. But I think the big thing is for people with significant wealth outside the UK, for that potentially all to be drawn into the UK IHT net, and taxed at 40%. You can absolutely understand why people might think, well, that's far too high a price to pay, for the UK lifestyle. So I think, but also I suppose sometimes it's easy to underestimate just how difficult it is to sort of extract yourself from one kind of lifestyle and move somewhere else. I mean, one thing we do see is increasingly clients talking about, I'm going to move to Dubai before I sell my business, and because there's no capital gains tax in Dubai, and I'll save 24% on the sale proceeds or whatever. We have quite a few conversations, but when you start to explain to people, well, actually you need to stay out the UK for at least 5 years, otherwise you just get taxed when you come back. And they start to sort of question themselves as to whether actually the disruption that it causes to their life is that actually worth the tax saving that we're making. And if you're talking about stratospheric numbers, I think most people could kind of suck it up and live in Dubai for 5 years, but if it makes the whole conversation a lot more marginal, because I think people assume, well, I've just got to be out for like 12 months, be non-resident when I sell, and then I can come back and everything carries on as before. And the reality is, the government aren't stupid. They thought about that and said, well, actually, if you're going to argue that you're not a resident when you sell, then you need to make sure you're committed to it and you stay out for at least 5 years. Otherwise, we're just going to get the tax off you when you come back anyway. So I think, yeah, it's a long-winded answer of saying I'm sure there has been a significant number of people who have left. I've got no particular handle on what that looks like, but I think it's very much, to me, it's more the inheritance tax than the income tax aspects of it were the things that I think would drive people away, because losing 40% of your worldwide wealth in a country the way yes, you're a resident here, but it's not home. That seems like a big stretch. I can imagine there'd be a lot of people who would find that very unpalatable, frankly. So
With business owners that you do work with that have big questions about, okay, what's going to happen to to my situation when, for example, I do sell my business, and then there's the capital gains tax, there are all other tax implications. So, and then they go through all of that, and then there are there are further considerations when it comes to their personal taxation, right?
yeah,
So there are two things to consider at the same time. Um, on the balance of things, I suppose again it depends on what it is that they want to do after the sale of business, as you said, right? So
yeah,
so I
exactly.
suppose that your advice differ depending on that?
It does to a large extent, really. I think I think if they're looking to sort of retain the wealth, and you're right, I think it's very easy just to think, we get to completion day, everything's signed on the dotted line, and you think, wow, that's great, I've got all that money in my bank account. Um, but I think without pre-planning around that, worst case scenario, you walk out the door of the solicitor's office in front of a bus, get knocked down, and you lose 40% of that cash in inheritance tax straight away. So, I think there are certain steps that we would look to try and do to sort of mitigate that in advance of the sale, I think, effectively. But you're right, it does depend to a certain extent on what they want to do. They kind of, there isn't a one size fits all answer. Often they might want to sort of transfer wealth to the next generation, but they don't feel the next generation are ready for that wealth. So we might then look at, well, is there some trust planning that we can do, for example, that kind of effectively transfers the wealth outside their estate, but doesn't transfer it directly to the kids who frankly might end up in a bad marriage and be at risk of losing half of that. These are the sort of things that people do concern themselves about. Sometimes we do get clients who essentially say, well, my inheritance tax plan is basically to spend all of the cash, so as by the time I die there's nothing left. Fine, okay, so good luck with that. And there are other people who are really focused on that investment strategy, or that going again, we want to reinvest into a new business, and again that produces a very different outcome in terms of the inheritance tax, because although the business property relief for IHT is going to be less generous, it is still significantly more generous than the 40% on non-qualifying assets. So if they're looking at reinvesting, building another business, then that drives potentially a different approach to if they're looking at just effectively having a whole pile of investments or passing the wealth on to the next generation. So it's understanding why they're selling and what they're looking to do post sale then does change the advice, I think, in terms of what the structure needs to be.
What would you say has been, just as an example off the top of your head, an example of where you've advised client that led to perhaps the biggest value creation in terms of tax optimization?
Yeah, well, I think it is probably at the really simple stuff. So effectively, sometimes it is about how can we effectively split a group up so they can keep part and sell part without there being tax liabilities. So a classic example, we had a business that had a commercial property portfolio, and they also had a trading business, and they wanted to sell the trading business, retain the commercial property portfolio, and kind of, I guess, the simplest answer is, well, we just extract the property portfolio, but that costs you a fortune in tax, both at the corporate level and at the sort of personal level as well. So by kind of putting in place a relatively standard but capital reduction demerger type structure, we actually managed to separate the two parts of the business out tax free. And so they sold the trading business but kept the property business without losing any value as a consequence of the separation. So, and that was in anticipation of the sale. So if we'd kind of just left it and said, well, we'll sort it out as part of the deal, they might have ended up losing 24% of the value of the property portfolio. So it doesn't necessarily have to be rocket science. It just needs to be to have the tools in the toolkit to be able to kind of say to people, we can actually achieve this in a more tax efficient way. And sometimes it's as simple as just making sure the deal's structured in the right way. So, even down to the legal paperwork being drafted in the right way. If you've got an earn out, then there are risks that if you don't structure that properly, HMRC say, we want to tax that as income rather than capital gain, for example, and you lose 20 odd % of the value of that. So there was a couple of situations where we had that, where the initial deal was kind of, well, we want to give an earn out to A, B, and C, but we're not give it to D and E, and it's kind of, well, we do need to think about that and how we structure that, because the revenue say if you're only giving the earn out to certain people and not the others, why is that not income for those people rather than extra proceeds? In the end, we got to an answer which probably was a bit of a compromise, but it saved a nasty shock down the line. So, it's, I suppose it's, you can't often say, we've waved a magic wand and we've saved you an absolute fortune, but it's more about sometimes in that situation de-risking rather than necessarily being able to point to and say, look, you've suddenly ended up with £1 million extra in your bank account because of what we've done. We can get that result from time to time, but more often it's the simple stuff that gets overlooked, I think, is the clever stuff can sometimes become too clever and also you disappear down in a bit of a rabbit hole, really. So
when you reference the clever stuff, what are you referencing here, anything in particular?
So, I mean, in the good old days, we might look at all kinds of planning, like offshore structures and Jersey trusts and sort of Maltese two-tier structures and all of this kind of exciting stuff. And you can do that, but the sort of, because of revenue's got a much more aggressive approach to what they consider to be tax avoidance these days. A lot of that stuff is either too complicated or too risky or just flat out effectively against the rules anymore. They've taken quite a lot of the fun out of it, unfortunately. That's not to say there aren't still structures that are available like that, but I think certainly at the SME level, which is the level that we're dealing with, the costs of maintaining those and the compliance that goes with them make them fairly prohibitive these days, I think. So it's a lot more about as I say, really listening rather than coming and effectively here's a box of 5 tax solutions. Which one would you like to buy? It's more listening to the client and working out what we can do to help them achieve the objectives now, which is the right way around. Frankly, I'm not a fan of just doing stuff purely to achieve a specific tax outcome, because that definitely leads to problems down the line as a rule.
Do you often see that as a problem where a business owner might come to you and they might have an idea of what they're trying to achieve, and then you end up, as you said, you listen to them and you kind of go, okay, this is the objective, and you go, well, actually, to get to that objective we have to do something very different?
Yeah, I think business owners, they're entrepreneurs, right? More often than not, and they kind of don't necessarily see the barriers; they only see the opportunities. And you do sometimes feel like you're a little bit of the sort of the taking all of the joy out of things by explaining to them what they can't do rather than what they can. But as long as we, there's usually a route. It may not be quite the route that they're sort of looking for, and it might sometimes take longer, or it might not necessarily achieve all that they're looking for. But I think if we work with them, we can generally help them to understand. Often it depends on the client's risk profile as well. Some clients say, look, I just want to be absolutely straight up and down the line. I don't want to do anything that could potentially get me in trouble with HMRC. Absolutely great, fine. Some clients, from my point of view, tax is uncertain. And so you can get to a position where, well, we think actually, do you know what, that's a fair argument. We've got a reasonable argument there. HMRC might disagree, but as long as we've taken a reasonable view, then we can have an argument about it with them and potentially get you a good outcome. We'd never put a client in a situation where we're saying to them, well, if you do that, then as long as HMRC don't find out about it, that's fine, because that's absolutely not where we want to be. But you don't necessarily also have to just look at what HMRC say and say, yeah, okay, we're going to follow that all the time, because that's their view, right? And strangely enough, they tend to sort of have a view which leads to them collecting more tax rather than less. But you've got to work with the business owners, help them to understand where that line is and how close to that line they want to get, with making sure that they never go over that line, because we're not in the business of advising people on something which is flat out just not going to work or is just going to cause them a world of pain in the future. Because nobody ultimately wins. Nobody ultimately wins out of that.
In terms of, for anyone who doesn't know, what is the main difference between what you do and a wealth planner?
So what we do, I guess, yeah, it's an interesting and actually it's funny because we often have the conversation. Wealth planners are tending to stray more into IHT planning now, and kind of onto the territory that we used to kind of occupy. So I think essentially the wealth planner, what we can't do is we can tell clients, well, if you make an investment of this type, then these will be the tax outcomes. What we can't say to them is that's the right investment that you should make. That's where the dividing line is, I guess. So, like a client wants to put a load of money into their pension or buy a building in a pension, for example, is might be a good example. We can explain to them, well, if you buy a building into a pension, then effectively the rent goes in tax free. The increase in value is tax free in the pension fund as well, and the company gets a tax deduction for it. And so there's all these good reasons why that might technically work from a tax point of view. But then where the wealth planner then comes in to say is, but actually in terms of what your aspirations are and your overall financial planning, is putting the building into the pension the right thing to do in that broader context. So we're almost kind of advising on the consequences. And then we can say, look, if you do it this way, this means X. If you do it that way, that means Y. But if it's a choice between different ways to invest cash or to sort of manage their wealth, then that's where the wealth manager comes in. We can advise what the alternative solutions might be, in terms of the tax outcomes. But then we need to, and we do work very, very closely. So, we're in a lot of meetings with our sort of wealth management kind of IFA counterparts with clients to kind of give them both perspectives, and increasingly so with the IHT changes, particularly around pensions rather than BPR. It's kind of, we're working hand in glove with a lot of the financial advisors that we work with to try and make sure that we're giving the client that kind of full circle advice, if you like, the 360 advice, rather than just narrowly looking at it from our bit, and then the wealth manager, the wealth planner looking at it from their bit as well. Mm-hmm. And you also need the lawyers in the room quite often in that situation as well. So mm-hmm. I think, but as you say, there's a real sense in which what used to traditionally be the preserve of the tax advisor, I guess, wealth planners are kind of moving more into advising clients around IHT. So it's often a case of just being very clear where the demarcation lines are in that conversation, I think.
At the end of the day, for each niche, there is a specialist who can advise best, and then you get an all around advice, and that's everyone is a winner at the end.
Yeah, 100%. Yeah, I think that's the key. Is it everybody? So it's a bit of a cliche these days, isn't it? But you do need that holistic advice. You do need to look at all of the aspects rather than just narrowly looking at one part, because it's quite conceivable that our advice could point a client down one road and the wealth planner's got them heading down a completely different road. And if we're not talking to each other, then you could end up, sort of going in, getting pulled in two totally different directions. So, being sitting in the room and having that broad-based conversation is critical with the client, I think for us to
wrap this up, my last question that I ask everyone really is, in your view, when it comes to the M&A scene, specifically in the UK, because of the changes that are happening legislation-wise and so on, what would be your prediction for the next 5 years? How will it potentially change?
I think at the moment we seem to be in a period where it's slowing down quite a bit, and people are very nervous about transactions. So I suppose whether it's a prediction or a hope, but if we can get a bit of stability into the tax system and into the economy as a whole, I think there's almost built up demand, because a lot of people are at the moment thinking, well, I could sell, but maybe it's not the right time. So I'm sort of maybe hoping rather than expecting that if we do get a degree of stability. And the tax system is a big part of that. If we can get some stability and predictability in the tax system, people feel more comfortable, and we might see quite a significant uptick in M&A activity, because a lot of our business owner clients aren't getting any younger. Well, none of them are getting any younger, and so they're going to be looking at exits. But at the moment, people are think, well, with the IHT changes, with the capital gains tax changes, maybe I just keep ploughing on rather than making the exit, because there is that degree of uncertainty. So, as I say, it might be more of a hope than a prediction, but I'd like to think maybe once things settle down and we do get a degree of consistency in tax policy, if nothing else, that if that ever actually happens, which again evidence suggests that is unlikely, but if it does happen, that we might see some positivity return to the market, because it does feel a bit flat talking to the corporate finance guys at the moment that I'm speaking to. But maybe I'm only getting a very narrow view of it. But yeah, I'd like to think I'm optimistic. Yeah. But I think there's a few preconditions that need to be met before we see that uptick, I think. So.
Fingers crossed. Thank you, Paul.
Absolutely.